Hey everybody, so today I'll be doing the performance review for the first week of May 2021 for the Phoenix algorithm. I'm going to start by going over the disclaimer, then I'm going to go through all the different trades we had, and then towards the end I'm going to be doing a series on the emotions of trading. And I think you'll want to stick around to watch that, especially if you're currently a customer and you you get frustrated like all of us do with some of the different emotions that can be involved with trading, whether that's fear or greed. I'm going to look very closely at one of the trades we had that we closed on Thursday and just talk about the emotions involved in it and why it's usually best to just sort of let the algos run or do your best to let them run and then try to not watch necessarily every tick as the day goes on. So with that, why don't I jump into the risk disclosure. All right, so go ahead and pause this screen if you need to. This is the same one that we always show. Basically, I'm just saying that there's risk of loss in trading futures. It's not for everyone. It should be used with risk capital only. I'm not a commodity trading advisor. I'm what's called a third-party developer. These algorithms are traded under a letter of direction by NFA registered brokers. So with that out of the way, and of course keep in mind past performance is not indicative of future performance. So with that out of the way, let's go ahead and look at the final results for this first week of May. Okay, so for those of you that are new to what we offer, this chart just shows the Phoenix algorithm, and this algorithm trades three individual algos. It trades a momentum 10-year, which is the top left algo here. It trades the Phoenix day trade, which is the bottom left, and then the momentum ES algo, which is this one on the right. This one on the right, it's also been called the bullfire in the past, but it is sort of the main algorithm that we trade on the S&P. So, and just a reminder, if you're on the swing trader, one of the legacy algos, that trades the 10-year note plus this momentum ES. What the Phoenix does is it trades those same two algorithms, but it adds this Phoenix day trade to it. Now, for this first week of May, what I gave the algorithm was a B+, and I'll go ahead and explain why I did that. But basically, we were up 6.46% for the week. So that's basically if you take the net liquidating value on any statement you had on Friday at the close versus the net liquidating value of what you would see at today's close. That was a gain of about $1,292 per unit traded. So per $20,000 that you traded, that was a gain of $1,292, and so that equates to a 6.46% return. So it was a positive week for us. It didn't start out that way, but it certainly closed positive for us, and so that it was a really good week. Now, there's only one reason why I didn't give it an A, though, and that was because of the day trade algorithm. It underperformed, and so so let me talk, though, about each one of these, the 10-year first. So the 10-year, we entered a 10-year trade on the 14th of April. So we've been in that trade now for a few weeks. And as you see on this chart, you see this big spike right here on in the first candle of the day. That was from the jobs report that was released today. And then the 10-year sold off a bit. But so that's Friday. Right in here is Thursday, Wednesday, Tuesday, and Monday. So right here is sort of the start of the week. And as you can see, the 10-year rallied. And so even though the S&P also closed higher, the 10-year actually did as well. And usually they do trade inverse to one another, although not all the time. The correlation last time I did the analysis was about negative 30%. But the bottom line is that the 10-year continued to outperform even though the S&P was also bullish. So this one got really 100% in my mind because of it being up, even though the S&P was down, was also up. The momentum ES, that's this one over here, also closed positive for the week, and by a decent amount actually. But the week didn't start out like that. In fact, over here you can kind of see Monday, and by the way, this chart looks a little bit different than the one I usually show for the momentum. That's just because this one shows the overnight action on the S&P, where the other one doesn't. It only shows when the equity markets are open. But for the purpose of the segment I'm doing towards the end of this presentation on the emotions of trading, I wanted to show the 24-hour version of it. But it's still the same algo, it just looks a little bit different on the chart. But basically, so I added these arrows to help highlight the actual trades that we saw. But coming into Monday, we were flat. And then towards the close on Monday, we bought. That's this little blue dot. You can probably barely see it right here. The next day, the market sold off, and the market gapped down lower and then sold off from there. But we got out with a normal stop out. And so actually, I think it was a little bit bigger than our stop, but we got out with a loss right there. Then the market sold off, so it actually felt halfway decent. Even though we got stopped out, it did the right thing because the market then sold off more. But then towards the end of Tuesday, we got into another trade. That's the little blue dot you can probably barely see, but again, the green arrow is put there to try to help show you where the trade actually occurred. But this trade was the one that I'm going to analyze towards the end. But you can see here it actually ended up being a really good trade. And if you are using the Phoenix or any of our algos really, you would have seen this. The only one that didn't was the Wave Trader. The Wave Trader did not see this trade, but all the other ones did on the legacy algos as well. But it got in on Tuesday, held all day Wednesday, held all day Thursday, and then got out at Thursday's close. And then the market continued to rally on Friday, which was today. And if you're wondering why we missed out on any trades here, this day trade, the Phoenix day trade, actually did see some gains from it. It actually bought towards the open, or about 20 minutes after the equity markets opened this morning, and then got out just before the close with a nice gain. But that leads me to this day trade algo, which is the only reason why, again, I didn't give us an A was because of this one. So we got stopped out of a trade. I'm sorry, we didn't get stopped out, but we exited at the close with a loss on Monday. And then Tuesday we were flat, but again, the S&P Momentum ES bought. But then on Wednesday we had another gap up, and this algo bought and got stopped out pretty quickly actually for a loss. And then and so that obviously wasn't fun. Market did end up closing about where we got stopped out, so that's certainly better than it turning around and rallying. But so then Thursday we did not have a trade, but then Friday we had a trade today, that is. So we had 3 trades this week. Now, if you followed the videos, I believe the month of March we had a total of 3 trades. So we actually have had a large number of trades this week, and so far in May we've already had the same number that we had in the entire month of April. So overall, though, this algo did not really do that well. It closed down for the week, but fortunately, the Momentum 10-year and the Momentum ES algo closed positive, and so that's why we ended up with a pretty good gain, actually, about 6.5%, which is a great gain for 1 week. Again, total gain on that was 1,292 per unit traded. Now, if you're on the swing trader, and I'll just highlight the other legacy algos real quickly, and then we're going to go into the emotions side of trading. I really want you to stick around for that, by the way. But if you're on the swing trader, you actually had an even better week, because you had the same gains the 10-year had, the same gains the Momentum had, but you didn't have the losses that we had on the Phoenix day trade. If you're on the Pro Trader or the Crusher, then you also saw gains, and the gains actually would have been about as the Phoenix was, because the day trade on the Pro and the Crusher is very similar, only it has a tighter stop, and so the loss on this trade in particular would have been about half that amount. But again, this is why I'm trying to really focus on the Phoenix, because that's it, it's easy to get confused with all the different algos that we do offer or have offered. But I am trying to highlight in the month end reviews the net, or the kind of the final returns that the other legacy algorithms saw. But again, if you're a legacy customer and you want to move to the Phoenix, you certainly can. You have to make sure you've got the 20K per unit that's required for it. But yeah, it was actually a great start to May. 6.4% is great, and the S&P actually did close up for the week, but we actually did outperform it. So it was actually a really good week for us, even though certainly didn't feel like that, especially at the start of the week. But with that out of the way, let me go ahead and get into this next slide, which is where I'll be talking about the emotions of trading. All right, so what I wanted to do was just highlight basically this trade right here. Now, if you didn't experience this trade, it probably doesn't look that bad actually. It actually probably looks like a great trade. But you have to look a little closer, because what you see is we got in towards the close on Tuesday, then it rallies, then it sells off, then it rallies, then it sells off, then it rallies, sells off, rallies, sells off, and then rallies again. So you can imagine, so this is a great example of how trading can certainly be difficult due to the emotions involved. So I wanted to talk about the emotions of trading with the hopes that it might help my customers just sort of keep things in kind of in a good frame of mind, kind of a high level view of where you should try to stay at as you evaluate the algorithms and as you experience them in your account. So so that was sort of a long-winded introduction to this next section that I'm doing right now on the emotions of trading. All right, now one thing I am doing on a few of these slides is I just have a few quotes on the right, and these are from a few of my favorite quotes related to trading. And what you'll see is that they pretty much all of them are derived from this turtle project that was started in the 80s. And a lot of you are familiar with that, but it was in essence a group of people that had no experience trading that were hired to basically follow the rules that this guy Richard Dennis and another guy basically gave these people these rules to trade. And they said basically just follow the rules and you'll do fine, but just whatever you do, don't override the rules. And I'm paraphrasing it horribly, but basically it was one of the first, in my opinion, kind of fully algorithmic kind of trading systems. And it's one of the reasons why I got into quantitative trading was really because of this project, is because they actually had some success, but what they found was that most people that they hired could not follow the rules. Even their emotions got in the way, in other words. Even though they knew they had to follow the rules, for various reasons it just was really difficult, and so they couldn't. Not because the rules were too complicated, but because their emotions got involved. And so what you'll see is a few different quotes related to the emotions of trading. And if you haven't heard of the turtles, or if you're interested in the emotions of trading, the Way of the Turtle was one of the books that was written, but then this quote actually is from Market Wizards. So anyway, here's the trade, and let's look at it in depth. So what you're going to see on the bottom here is a volume chart. Now I'm adding that so that you can easily see when the equity markets are open, because again, this is a 6-minute candle, but it shows the 24 hours that the futures trade. So it shows basically the overnight trading that goes on the futures market. And because we hold the S&P overnight, it's fitting that we would show that I would show that as I talk about the emotions, because that's part of it as well. Because as you know, you can look at the trade, and it actually will fluctuate in the middle of the night as Asia opens up, followed by Europe, and then finally when the US equities open, that's when you start seeing the volume. So even though you probably can't see it very well, but it looks like there's no volume, there's actually volume. It's just very small compared to what you see when the equity markets are open. So yeah, so here's Tuesday though. So we got stopped out of another trade at the open on Tuesday, and I should have probably showed that again, but that's this trade right here. And the reason why that's important to remember is it does add to some of the maybe drama, you could say, of this trade. Namely that we came into the week flat, but then we bought on Monday's close, and then on Tuesday morning we got stopped out of a trade. So we started off with some losses there. And I believe we also had that day trade. So that's how the week started. You know, we were already down. And so when you start the week off down a bit, you really want, you know, any gains that you see, you just want to lock them in. That's the emotions of trading. You know, that's a balance of the fear of you don't want to have more losses. And it's not even really greed. It's more you just, you know, want to kind of make some gains back and try to kind of start fresh in essence. But we bought the S&P on Tuesday at 154 Mountain Standard. Now, all the times that I give are Mountain Standard. That's because of where I live. It's Mountain Time Zone. So if you're on the East Coast, just add 2 hours. So we bought at 3:54 p.m. Eastern Standard or 1:54 Mountain. So 6 minutes before the equity markets closed is when we bought. So we got a good fill of 41.49, and you can already see that after we bought, the market actually spiked for the final kind of 6 minutes of trading before equities closed. It actually spiked a decent amount, so we were actually up a little bit on this trade right after we got in. But happens a lot, in the overnight, it just sort of fluctuated a bit, and then it actually started rallying and went higher. And so in the middle of the night, it was up even more. So if somebody was looking at this trade kind of maybe in the middle of the night at like 3 o'clock Eastern Standard in the morning, they would have seen we were at about 41.70. So we were up about 20 points right in here. And that 20 points equates to $1,000. So we were up $1,000 per unit traded in the middle of the night. And then people probably started waking up, and you start looking, and a lot of people probably saw that it even went higher. In fact, the high was at about 41.79. There it is. So 41.79, which would have been 30 points. Again, we got in at 41.49. So a 30-point gain, which is $1,500 per unit traded. Again, every point is $50 on the S&P. So that's the first kind of thing that happened. We got in, and we're pretty much within just the overnight session, we were already up $1,500 on a 20K account. You know, that's, 7.5%. So this trade actually was looking amazing, especially when we were already down a bit. That's the kind of thing that obviously we want to see. But what happened is, what happens many times with some of these trades, let me move that over a bit, is once the market opened, again, here's that spike, once the equity markets open, the S&P just sold off. And so by 8:24 a.m. Mountain Standard, this trade that was up $1,500 was now only up about $262 per unit traded. And again, we were already down from the previous 2 days, and so that felt like we were dropping the ball in a pretty massive way, actually. But we were still in the trade. We didn't get out, but this just shows the emotion. So there's everyone's happy because it's up, and then an hour later, everyone's bummed out because now the trade is down. Which, by the way, I'm not faulting anyone. That's how we all are. I'm just showing this more to highlight the different emotions involved, and then I do have a point at the end of this that I'll try to make as well. But so then Wednesday, again, sold off, but then look what happened. It rallied. So about the time that we felt that things were looking really bad, then the S&P really took off, and it actually went all the way back up to a little bit above the high, and now the high was actually above the previous high by, only about $50, but it was still a little bit above it. So again, now there's that kind of emotional high of now the trade is back again, and it looks like it's screaming higher, and it at this point, if you were watching it, you probably felt like it was just going to keep going up, and it almost felt like easy money at times. Or you might have been of the opinion that it's going to roll over again? How come he's not getting out? I mean, everyone is a little bit different, but no matter what, everyone was at least happy that it was up now again. All right, so then what happens, as you might expect, is that the market, once it kind of retests that high, it actually just sells off the rest of the day. And by the close of Wednesday, this trade is now only up $600 per unit traded. Now, still a great gain. Being up $600 is great. But remember, it was up about $1,500. And so, I know for a fact that we all felt, like, wow, what the heck is going on here? Why didn't it get out, when it was retesting the high maybe? But the thing with algorithms is that they will do what they do based on what all the previous data in the back test has shown, and then also, refine based on what the live trades show. But they will do what they do. They don't follow necessarily the the day trading for dummies kind of ideas that are out there. Not to knock those ideas, because they're there for a reason. I think they do work depending on how they're used. But for these algorithms, those kind of things don't necessarily work all the time. But even if it did work and this sold off, I think the last week video I did, I talk about why we don't have a trailing stop, and I showed the data. So if you're wondering how quantitative trading is different, I recommend you watch that. That was the video that I did, I believe it was last week for the 4th week of April, where I show more in depth this how the optimization works on an algo. And if it wasn't that one, it was the 3rd week. But you can also email me, and I can send you a few videos on that. But basically, though, on Wednesday, again, the market gapped higher, or it trended higher in the overnight, then it sold off, then it rallied again, and then it sold off again. And so we ended the day up about $600, or about $900 from the high that we saw. All right, so then what happens is, again, you see here the overnight session. So this is when Asia opens, and then Europe opens somewhere in here, and then the futures just sort of, they actually rallied quite a bit. And if you were watching it again in the middle of the night, you would have seen that we went all the way up to almost 41.75, which would have been over $1,000 from the entry, only to see it sell off the rest of the night. And then by the time the equity markets open at 9:30 a.m. Eastern, sorry, this is it should be Mountain Standard there, apologize. But so by the time the equities open, though, they open about where they closed on Wednesday, but then look, they just sell off. And by 8:24 a.m. Mountain Standard, they actually are down 425. So that trade that we got into on Tuesday that was actually up $1,500 twice, now it's down $425 per unit traded. So it actually was at a loss, and by now we're all wondering, oh wow, is it going to get stopped out maybe? But so that's a pretty big swing, and I'm mentioning it not to I guess just to show everyone that yeah, this thing does happen, and it's not easy when it does. But if you're kind of mentally prepared for it, it might make it a little easier. And again, I do have a point in doing all this towards the end that I'll bring up. But I just wanted to show you, though, yeah, I mean, this trade had a few different swings that would have driven all of us crazy, or certainly made us all frustrated. But the algo did what it does, and it held on to it, thinking, obviously, the algo thought that the market would rebound. Now, in this case, we all know what happened. It did. And so, yeah, I'm cherry picking a positive trade here, and I don't want anyone to think that that my goal is to show that every trade we do is positive or every trade's a brilliant trade. It's not. For sure it's not. But what I wanted to show is more that these kind of swings are normal and they will happen. And the worst thing someone can do is just kind of bail in the middle of it out of fear. So that's really kind of what I'm trying to show here, is how there's a better way to use these algos than to watch them every day tick by tick. And that's to basically just do your best to watch them, to track them, but to try not to look at them every second, because you will go crazy with it. Or it'll be very difficult to kind of watch the ups and downs. But let's continue here. So now Thursday, 9:54 a.m. Mountain Standard. Again, this an hour after equities open, it was way down here. It was down $400, but then basically about an hour, little over an hour later, the futures rallied real strongly, and they actually kind of retested the highs that we saw before, and they hit those highs again. Now, I know what everyone was thinking. At this point, we had already felt like we'd been through a lot, and the thought is always going to be, okay, now he should get out. Now the algo will get out. Certainly it'll get out. And there's fear. In this case, it's probably more fear than anything of just not wanting to see the gains evaporate again. So at this point, the S&P hits a high of about 41.79. It's a gain of about $1,500. So again, that's a positive swing to the upside of about 2,000 now. So it almost just reverses, and now it's the flip of that. But let's keep going and see what happens. So then again, we're on Thursday still, and if you were watching this tick by tick, you know exactly where I'm going with this. By this point, by 12:36 Mountain Standard, and that would have been about 2:36 Eastern, the futures have been selling off for an hour, and you can almost just hear everyone in their mind saying, oh, here we go again. It's going to keep selling off. We're going to get stopped out of it probably. Another winner turns into a loser. Why didn't we get out when we had the chance? And probably some of you at this point turned off your monitor or your phone and just was like, well, I'm not going to look at it because I'm going to go crazy if I keep staring at it. But at this point, the trade was actually still profitable by about $600. But for sure, the emotional toll at this point, if you've been watching it tick by tick, is pretty intense. But let's keep going and see what happens. So Thursday, again at 12:30 Mountain, it looked like it was going to roll over again. But that's actually the point that it rebounded, and it really just took off for about an hour and a half. So the futures rally real strong into the close, and the algo actually finally does exit, and it exits at 41.94. So our entry was 41.49. But notice how it did exit above that previous high that we all kind of were sort of hoping that it would just get out at. But it actually closed about $750 above that by the time we got out. So the algo got it right for the most part. Our entry was 41.49 on Tuesday, and we got out at Thursday's close for a gain of about $2,250 per unit traded. That's 45 points. So this trade was a really good trade for us, a really good trade. Now, to get there though was definitely not easy. This is not easy when you're watching it all day to see it go up and down and up and down. But in the end, it did do the right thing. So this is an example of the emotional whipsaw that can occur with trading. Now, the question though is there a better way to do this? Again, I'm trying to talk about the emotions of trading. Now, what I would say is this. I do think there's a better way than just following the trades tick by tick, because there's just it's a lot to go through. And wow, this is Thursday. Sorry. I'm trying to get this video done before the weekend. But so basically though, there is a better way to do this, or to look at these algos, and that would be to simply just look at them more kind of ideally, if you can follow them and look at the statements at the end of the day, and then periodically it's okay to look, but just not sort of hyper focus on how much they're up, how much they're down, but just sort of let them do their thing. Then it's just a lot easier on your emotions, because obviously this was a great trade. I mean, if all you knew was this was our trade and we were up $2,250, I don't think anyone would say, well, horrible trade, why didn't you get out at the top here and then buy at the bottom here and then get out at the top here again and then buy at the bottom here? Because if you've traded, you know that it's easy to see this once it's done and say, why didn't we? But in the moment, no one knows that it's going to keep rolling over or going higher. I mean, but that's what the algo does, is it's making real-time calculations every time a new candle is created to determine if it should get out or stay in or change things up. And so that's what the algo is doing, and that's what my customers have sort of bought into. Now, again, I want to also mention the risk, though. For sure, this trade could have gone the other way. I mean, it could have just sold off. And if that were to happen, then I would refer you to the other video that I already mentioned, where I talk about the optimization and why we do the things we do, because the code actually says that's the best way to do it, as opposed to, and this is actually a good example. If we had a break-even stop that would have triggered, we would have stopped out over here at break-even before we went down 400, and we would have missed out on this $2,000 gain. So that's why we do it. Now, it's easy, though, when we're in the middle of it, to forget about these kind of trades. And that's another reason why I wanted to do this video, is just to remind everyone that this, we do have to celebrate the good when it occurs, because, yeah, it's not always going to work out this way. But, it's best to just sort of let it run if you can. And that's, of course, this should only be traded with risk capital. I'm not saying to close your eyes and never look at it and just trust it. This is ultimately your account. It's traded under a letter of direction, so you still have full control of your account. You can actually call up the broker and have them exit early if you want. They have certain rules that I shouldn't say rules, but they have a way that you have to do that, though. But you're able to do it. You're able to pause it. You're able to get out early if you want. And we actually did have a few people that I believe they did get out early yesterday and missed out on this gain. But for the most part, most people let it run. But again, the reason why I'm highlighting this is just to remind everyone that the better, or the more you can separate yourself from the day-to-day, or I should say probably the minute-to-minute fluctuations, the better, because we're going to have a lot of trades like this. This is not the first time this has ever happened, and it's not going to be the last. In fact, most trades that you hold for more than a day are going to have some kind of movement like this. I mean, it's very rare that you kind of get in at the very bottom and get out at the very top. But now in this case, we actually did get out at the top for at least this 3-day period. But a lot of times that won't happen. So the best way to handle it is to sort of try to separate yourself from it, let the algo run, and then kind of do an analysis at the end of every day, or at the end of every week, or the end of every month, and see where you're at, as opposed to seeing where you're at kind of every kind of 10 minutes. All right, so, but in the end, it's your account. You have access to the Gain Broker app, so you're able to see the day-to-day or the minute-by-minute. And ultimately you can, but if your emotions are really driving you crazy, I might just suggest you could just not look at it every day, or kind of pace yourself with it, I guess. So I think I've really beaten that point to death. So let me go back to this slide, which shows the summary. So again, by the way, here's that trade. And again, when you look at it here, it doesn't look that bad, right? It just kind of looks like we got in and got out, and yeah, I'm sure a lot of people are saying, well, wait a second, why didn't it stay in until today and get out at the close today? Well, yeah, that would have been nice, but the algo has risk mitigation things in it that will do its best to get out before the weekend. And in our case, it ended up exiting on this Thursday. But if you're looking at this saying, why didn't we get in? Remember, it did get into the day trade. So if you're in the Phoenix day trade or the Pro Trader or the Crusher, you would have seen that we were long that trade actually, or for part of this. But anyway, yeah, so we ended up closing the week up 6.5%. I gave it a B+. The only reason I didn't give it an A was, again, because of the day trade. The day trade was at a loss. Wasn't a huge loss, but it was still a loss. And with the market being up like it was, I would have expected it to hopefully not be down the way it was. But it'll happen. This is all done on the basis of a long-term average of trades. But the 10-year certainly did amazing, and then the momentum S&P actually did amazing as well. Even this one, the one thing I didn't say is like this early stop out that we saw, this is actually normal. It's not crazy that we have a stop out, and if we would have had that stop out, I would not have said that we don't get an A for that. In other words, those stop outs happen, especially as the market rolls over. Now, if you have a stop out like that, but then the market immediately reverses and goes higher, then I would say, yeah, that was an issue because our stop didn't get it right in that case. But in this case, it definitely got this trade right, even though there was a few ups and downs in the middle of it. But I think that's all I got. So I hope everyone enjoyed this one. It was a little bit longer, but hopefully it was helpful to just go over the different emotions of trading. And again, I apologize for the typos on the screen. The negative about doing these weekly videos is to do the slides takes time, and sometimes I'm a bit rushed to get it done. So yeah, I apologize for that. But I'm much more of an engineer than a marketing whiz, so I guess I can just blame it on that. But anyway, I hope you guys have a great weekend. And looking forward to hopefully another positive week 2 for the second week of May. All right, so we'll talk to you later. Bye-bye.